Hey Bowtie Nation, Joseph Hogue here. Thank you for joining us for another Monday market update, 9 a.m. Eastern, every Monday morning. Get you ready for the week, stocks to watch, economic news that could guide the markets. Higher for longer is the new mantra on Wall Street, folks. And if it's true, investors need to start thinking about which stocks are going to benefit from those higher interest rates. And it's not the Magnificent Seven stocks. Those shares of Nvidia, Amazon, Tesla, Apple, Microsoft, Alphabet, and Meta at one point accounted for nearly all of this year's returns, but have fallen an average of 9% over the past 3 months. And as much as I love dividend stocks, it might not be there either. Here we can see the S&P 500 dividend yield versus the US 10-year Treasury yield, and investors are being pulled out of yielding stocks into those Treasury yields that haven't been this high in 16 years. In fact, on the right here, we can see that the S&P 500 dividend yield at just 1.5% hasn't been this low compared to those risk-free treasury yields in nearly 2 decades. Fortunately, there are some stocks that love higher interest rates, and they're not all what you would expect. I found 7 stocks that benefit from higher interest rates, whether through their business model, the industry, or collecting a higher return on their cash that you're going to want to see. Stick around after that. We'll do our Monday market update, the stocks I'm watching this week, and the economic news you need to see. But first, with those higher interest rates, there is nothing wrong with holding a little more cash and getting one of the best returns I've seen in almost 20 years, like the 4.6% savings rate you get with Sofi. Sign up for the Sofi savings account with the link I'll leave below, and the bank is going to start you off with $25 free. Set up direct deposit, and Sofi will give you up to $250 more. I use Sofi for banking and investing. I get an interest rate 11 times higher than the national average on my savings, along with no fees and automated investing in the investing account. Just look for that link below and check it out. Back to our main topic though, because investors have been spoiled on nearly free money for almost 2 decades. Here we see the 10-year real interest rate, which is the interest rate on the 10-year treasury minus the inflation rate. And you can see here since 2003, the real, that after inflation cost of borrowing, has been under 2%. For most of that time, in fact, it was under 1%, and several times it's been negative. The company was paying people to borrow money. On that free money bonanza, consumers borrowed to spend, and companies invested in even the most marginal projects. Companies that wouldn't be profitable for many years were able to get funding because, well, sure, why not when money doesn't cost anything? Now though, and you can see in this chart just that huge rise in the interest rate over the last year, now that interest rates are back over 2% on a real basis and near 5% nominal, companies and consumers are being more careful with their cash, and investors are looking again at where to invest. And we all know what happened. Those unprofitable companies that boomed during the pandemic have fallen 80 and 90% from their peak. Here we see the ARK Innovation ETF, the ARKK, probably the best known proxy for those unprofitable companies, those growth companies that just boomed during the pandemic. But you can see here it has fallen from $156 a share down to just $34 each. Now those higher rates and the slower economy that it could bring have started to hit even profitable companies. The Spider S&P Bank ETF here, this KBE, has plunged 25% this year on that banking crisis, spurred by those higher interest rates. Real estate stocks fell 25% last year and are down another 11% this year. Here we see the real estate sector Spider Fund, the XLRE, down from $51 a share in December 2021, down 37% just over the last 2 years. Even the heavyweights like Alphabet, ticker GOOG here, are feeling the effects, with the shares plunging 10% last week on lower business spending for their cloud services. But there are some companies, some stocks that benefit from higher interest rates. In fact, I found some stocks that love these higher rates, and they're not all what you would expect. I'll start with 4 stocks that benefit from those higher interest rates through their business model, then show you 2 that are booking massive profits on interest. I've highlighted insurance companies like Progressive, ticker PGR here, recently on the interest rate theme. Shares are up 14% this year as the company is finally earning a respectable return on its massive cash reserves. And remember, nation, insurance companies collect those premiums, but then have to sit on that cash just to pay unpredictable policy payouts. Regulatory guidelines then limit how much they can invest in longer term and higher return assets, so much of this cash is just sitting in money market and cash-like accounts. With those rates back up to multi-decade highs, insurance companies are earning a solid yield on their reserves, with PGR expected to report 19% revenue growth and 22% earnings growth this year. The Fair Isaac Corporation, ticker FICO, is also likely to benefit from this high interest rate environment. The provider of the FICO credit score is expected to see revenue jump 10% this year. That's a lot for an older, mature financial services company, as consumers and businesses just pay more attention to the credit scores and their interest rates. Shares are already up 41% this year and trading a little expensively at 14 times price to sales ratio, but could still have some upside if those rates stay higher for longer. Another longtime favorite of mine here, the CME Group, ticker CME, runs that Chicago Mercantile Exchange. It's also seeing the upside from those higher rates through increased volume of interest rate futures trading. Now, understand here that futures and the options exchange benefits when that increased volatility and just the fear around rates brings more investors into those derivative products, those futures contracts trading on the exchange for hedging and investment. So a lot of companies will go into the futures market, hedge their interest rate exposure with those options contracts or with those futures contracts. That means a lot of trading volume for the CME and a lot more revenues. Revenue is expected up 9% this year, with the shares up 19% already. Now, those stocks and similar companies are going to benefit from the higher interest rates through their business models. The problem is the market already knows this. It's been bidding up those prices all year because they know that these companies are benefiting from those higher interest rates or the volatility around interest rates. They're going to continue to benefit, but those valuations are already stretched, and the remaining upside might be a little bit more limited. But there is another part of the market that's seeing a hidden benefit to these rates, one that the market has yet to realize. Nation balance sheet cash and some of the short-term assets a company holds on its balance sheet isn't meant for investing, but is set aside for cash needs in the business. The company isn't trying to earn a huge return on this cash. It's just trying to earn a respectable return to keep up with inflation and hold that cash there when it needs it for its business. And that means it's usually invested in safe and liquid assets like those money markets and those cash-like assets, earning next to nothing over the last 2 decades until now. So a few companies sitting on high cash reserves are now earning tens of millions of dollars in interest income, boosting their earnings and in the least likely of places. For example, Arista Network's ticker ANET. We're going to go here to the Financials tab in Yahoo Finance, into the balance sheet. I'm going to show you how to find this, how to analyze this for these companies that are really blowing the doors off this interest income, surprising higher on earnings, and are going to do really well for as long as interest rates stay high. Now we can scroll down here. We want to do the quarterly balance sheet. We can see here in the last quarter balance sheet, we can see here in current assets. Now, these are all assets that can be converted to cash within the next year. And in that, we see cash alone, right? Cash alone, the company had $3.7 billion in cash as of the last quarter. These receivables and inventory, these are things that are estimated to be turned into cash within the next year, so those are highly liquid as well. Then we want to compare that against the company's liabilities. Okay, that's the debt, that's the things that it owes. These current liabilities, that's going to be the debt and wages, things like that it owes over the next year. These total non-current liabilities is its long-term debt. Now, if we look here, $2.3 billion in total liabilities, that is covered completely by its cash. So it has net cash of $1.5 billion, plus all this other current assets that are going to be turned into cash relatively soon. All in all, the company has a net cash balance sheet of about $3.5 billion and is earning a solid return on that cash. Next, if we go to the income statement, this is the income of the company each quarter. If we scroll down here, we can see it booked $32 million in interest income non-operating. So non-operating interest income, that's just the interest it earns on its cash, plus this $24 million that it reported on other short-term investments that it makes on that cash. So in total, that combined $56 million, boosting pre-tax income by 10% in the quarter and over the last year. So Arista Networks is now booking 10% of its earnings just from that interest income that it's receiving on its cash. Another one you might not expect here, Snowflake, ticker SNOW. We can scroll down here as of the last quarter. It has over $4 billion or almost $4 billion in cash, $4.5 billion in current assets. This is all against just $2.2 billion in total liabilities. So the company could pay off all of its debt, all of its liabilities, still have lots of cash left over. But the company is cash flow positive, okay? That means the cash surplus is going to continue to grow. And if we come back here to the income statement, the company reported $73 million in interest income last quarter, $150 million over the last 4 quarters. That is up from just $11 million in the same quarter last year and just $2 million in the year before that. Okay, so that $150 million in interest income booked over this last year, that's added 45 cents per share in income. That's more than half the company's 70 cents per share profit. Okay, so this Snowflake, it reported 70 cents per share profit, earnings per share over the last year, more than half of that is just coming from this earning interest income that it's earning on its cash. Now, of course, shares have come down along with those other growth stocks, but that revenue is growing at 30% a year. And this is a profitable company that's going to continue to see interest income boost its results. Two great examples there, but they're not the only two stocks with these massive cash reserves that are benefiting from these higher rates. So to find these, again, you're looking at companies with a high amount of cash and those current assets relative to their total liabilities. Okay, so companies that could pay off all their current asset or their current liabilities, their current debt, even the total long-term debt, and still have lots of cash left over, earning that higher interest rate. That's going to be found on the balance sheet. You're also looking for the growth in the company's net interest income. Okay, so that non-operating interest income that they're collecting on that cash, you want to see that growing over the different periods. Really see that they are investing that and getting that higher yield, higher return on their cash. That's going to be found in the income statement. It's a sign it's earning more money on their cash. Let's turn it over to some of the stocks I'm watching this week. Generac Holdings, ticker GNRC, could report a very tough quarter on Wednesday as the leader in electric generators really struggles with its solar ambitions. The stock was the worst performing S&P 500 company last year and has lost another 18% this year as investors just really sour on its transition to solar powers. Okay, so this company still controls 90% of the generator market, though, which provides that strong cash flow it needs to build out its renewable energy segment. The company is expected to return to sales growth and earnings growth next year and trades for a very attractive valuation at just 1.3 times sales. So this is one of my favorite solar stocks right now because of that lock on the generator market, as opposed to a lot of your other solar energy stocks that are negative cash flow and need to borrow and need to sell equity in the company, diluting existing shareholders. This company is providing the cash necessary through that generator market rather than borrowing like those pure play solar companies. So it is not going to be diluting investors quite as much as those other solar companies, and it is still going to have that growth in the future when solar comes back into the market. Albermarle Corporation, ticker ALB, is down 53% from this year's highs and likely won't have much good news when it reports its earnings on Wednesday. If we want to look at what earnings expectations are for a stock, we can always go here to the analysis tab here on Yahoo Finance. We can see here for the current quarter, earnings are expected lower by 46% from the same quarter of last year, even as sales are expected to rise 13% in the quarter. Now, Albermarle got shut out of its planned acquisition for an Australian miner, Lionstown, recently, and that recent drop in EV demand hasn't helped lithium prices any, but the long-term growth in EV still remains intact here, folks. Even if EV does not hit its supposed 30% of cars sold in 2030, it's still going to have grown to millions of more cars sold annually. Lithium supply is one of the big bottlenecks to this growth, and that should push prices higher and benefit miners like Albemarle here. That's what I pointed out in a video last week by EV stocks that the market forgot. Check that video out because these are some stocks trading at very low valuations, very good deals for future growth. PayPal Holdings, ticker PYPL, also going to be reporting its earnings on Wednesday with the market expecting nothing from the fintech leader. Shares are down 41% over the last year. That is to say nothing compared to the 2021 peak. The company continues to meet or beat its earnings expectations, but growth has just disappeared here at just 1.8% sales growth this year. Now, against this pessimism, though, folks, the company is still the dominant leader in digital wallets and that fintech payment space. That's a position it should be able to translate into growth. Sales growth is expected up 9% next year with 13% earnings growth, and the shares are trading for a very attractive valuation at just 9.5 times 2024 EPS, the earnings per share. That's a stock that just last year traded as high as 50 times its earnings. Now, most of the market has sold out of this stock, totally given up on it, is expecting nothing, which could set the shares up for a surprise rally. Penn Entertainment, ticker PENN, is going to be reporting its earnings on Thursday ahead of the company's November partnership with Disney on the new ESPN Bet app rollout. I highlighted that deal in last week's video and believe it could eventually result in an acquisition of Penn by the House of Mouse by Disney. On Disney's marketing, it should help Penn grab considerably more of that sports betting market share and lead to growth for this company. DraftKings, ticker DKNG, also going to be reporting its earnings on Thursday with shares up 129% this year. This stock is one of the best performers in my portfolio and one of my forever stocks I'm holding for growth over really the long-term 3, 5, 10-year program. Sports betting is still in just 38 states and missing the big growth drivers in states like California and Florida, so lots of growth still left in this market. DraftKings controls 27% of that market and should continue to grow with that legalization. Now, that said, the company is not expected to be profitable for several years still and is trading relatively expensively at about 4.1 times its revenue. It might be prone to weakness on that higher rate environment, but I'm going to continue to buy shares at lower prices whenever it dips. Looking at the bigger picture here with the sectorspiders.com sector tracker giving you the look into the stocks in the sectors in the S&P 500, we can see that just one of the 11 stock sectors closed higher last week, with utilities really reasserting themselves as a safety sector. Now, we did see a drop in the yield in the interest rates on the 10-year treasury there, so we saw stocks in the real estate sector also do relatively well on that drop in interest rates, really rallying as some of the stocks are the hardest hit by rates this year. As would be expected, it was the higher risk stocks, the higher risk growth stocks and technology and communication services that really saw the most pain, while energy stocks sold off on that drop in crude oil prices. Now, that rally by utilities was interesting because we see here the utilities may finally be ready to live up to their traditional role as safety in a stock sell-off. Stocks in the sector have plunged 16.7% this year as those higher interest rates really drawing investors out of dividend stocks and into cash accounts like the CDs, like the money markets. Now, while the dividend yields on utilities still don't look as attractive as that risk-free 5% you can get with a CD, the valuations in this group are undeniably good, and none of this has changed the fact that the cash flows are extremely reliable and consistent for companies in this sector. Come what may for the economy, utility companies are going to sell their electricity, their water, and their gas. The renewable energy-focused stocks may still feel some pain here, but those traditional utilities like AEP, Duke Energy, ticker DUK, and Southern, ticker SO, should help protect your portfolio from the market's pullback. Wednesday's Fed meeting is going to be the big news of the week, but may not be what investors want to hear. Okay, the central bank is nearly unanimously expected to hold interest rates steady, with the CME Fed Watch tool not expecting another rate hike until January, if at all. But the problem is here, on that persistently high inflation, the strong economy, the Fed is going to continue to feel that need to talk up the expectations for rate hikes. That's just the game that it has to play. Both the CPI and the PCE inflation reports came in higher than expected last month. Last week's GDP report showed the economy growing at a 4.9% pace. That's the strongest in 2 years. Now, I continue to believe that the Fed is going to stay firm on rates into next year, and that the next move will be to cut, maybe in that May meeting if the economy does weaken. Higher rates are starting to crack parts of the economy. We talked about that last week, notably the banks, the real estate sector, and should do that job of bringing down inflation. That said, again, to keep the economy from reigniting, the Fed is going to continue to bully the market into thinking that it's going to raise rates again. It has to. Otherwise, if it talks about cutting rates or talks about the economy falling, then the economy is going to, or the market is going to preview those rate hikes, push the economy up further, push inflation back up, and that's going to defeat the whole purpose, right? This isn't what investors want to hear, though, and the idea of that higher for longer interest rates going to continue to be that negative trend in stocks and investor sentiment for the weeks to come. Don't miss out. Get your free cash bonus and an interest rate on your savings more than 11 times the national average with the link to Sofi in the video description below. Or click on the video to the right for the 5 stocks I'm buying for the next 30 years, my forever stocks. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.